probably need a new quarterback on the monetary policy team. Powell is facing the prospect of a split vote in November. He is famously noted for wanting consensus on the FOMC. So, we may see him step down after the election. That's my prediction.
Chris Whalen, chairman of Whalen Global Advisors, author of The Institutional Risk Analyst, an investment banker, and the best independent analyst you'll find on Wall Street, and a friend of this show. It is such an honor to welcome you back for episode 200, and we love having you on. I know, I love that you get episode 200 because you have been such an incredible friend of the show, our favorite monthly guest, so it's great to have you on today, Chris.
Wow. Hey, thank you. I appreciate all those accolades.
Well, our audience loves you, and if I had to pick my guest, it would be you for this occasion. And gosh, I feel like every time I have you on, it's always a busy month. A lot happens. We had a Fed rate cut. We had another assassination attempt on President Trump. So much going on these days. Tensions in the Middle East. Let's just kind of start with the big picture, that macro view, where we are today. And as you know, Chris, you can take all the time you need to set the table.
Well, macro view, I think we start with the U.S. economy and the Fed. We put out a piece yesterday about Jerome Powell jumping the shark. We're reminding everybody about Fonzie and, television a long time ago. And the way I would put it is the rest of the world is going into an economic stagnation, if not contraction, both Europe and China. And the U.S. is still growing faster than everybody expected. I don't think that's a surprise because there's still so much liquidity in the system. That is to say, inflation. So, the Fed made a terrible mistake back in September. They cut rates. They made this whole big hullabaloo and alluded to the fact that jobs are now topic A. But it seems like inflation is still very much on the table. And Powell spent a lot of credibility, both last week and, it's three strikes, Julia. And I think we probably need a new quarterback on the monetary policy team. Powell is facing the prospect of a split vote in November. He is famously noted for wanting consensus on the FOMC. So, we may see him step down after the election. That's my prediction.
Okay. So I remember our last conversation going into it. You said if they cut, it was going to be a mistake. They cut 50 basis points. Can we explore a bit more? Like, why did they do that? Were they just looking at the labor market, and now we got the most recent jobs report? Probably just talk me through the mistake. Why did they do it? Why did they make that mistake?
I think part of it is perspective, Julia. They don't realize, or they don't want to accept, that the extraordinary low interest rates during COVID 2021, 22 were not normal. Where we are today is probably closer to normal interest rates. Might be nice to have Fed funds closer to 4.5 than 5.5. But other than that, the economy is functioning well. Stocks are going up. Mortgages are being made despite the distortions caused by Fed actions over the past 5 years. So, it would be nice if we could get to a place where we weren't focused on the Fed and where we didn't have to wonder what they're doing every month. And I do know that a lot of people at the Fed that I talk to privately would love to be in that position. But I think Powell was stampeded by the street. He was also stampeded by the Biden administration that he clearly supports. And, once again, we're seeing a Fed chairman play politics. This is not anything new. This goes back to Arthur Burns, who I knew quite well. So, and Volcker did the same thing. Greenspan, not so much, because he mostly was in office during Republican administrations. But I think this is just a muddle, and the Fed has spent a lot of credibility, a lot of capital that they really did not need to spend. So I think we got a problem here. We need a new quarterback,
Yeah. Yeah. When you say new quarterback, any names come to mind for you that you'd like to see in that position?
Well, I think there's two people on the board you could pick tomorrow, Waller and Mickey Bowman. Mickey's great. She represents community banks on the board. Very level-headed, very professional. I think she'd make a great chair. And we could call her chairman, by the way. That's what the statute says.
Yeah. Okay. So the Fed jumping the shark. Have you thought about some of the implications of the rate cut? I suppose, like, okay, they might find themselves in a tricky position. Inflation could come back. What are the implications? Like, what did they kind of get themselves into by making this move?
I don't think the move in and of itself, Julie, is that important. The trouble is it doesn't fit the narrative. And so the Fed is in a position where they kind of would probably like to leave rates where they are for a while and just see how the economy performs, how prices and how inflation performs, say, over the next 6 months. We can't fine tune this week by week or month by month because we know we're going to be wrong. That's the history of central banking, right? If you try and do short-term fine tuning, you're always going to be wrong. So I think the big challenge for the Fed is that they have to come up with another narrative that deals with the legal mandate they have for jobs and inflation on the one hand, but that is also responsive and recognizes what's going on in the rest of the world. 100 years ago, the Fed was very deliberately trying to help Great Britain through World War I and the aftermath. The British were broke, and we took the baton. That's when the special role of the dollar started to become into existence. Was at the end of World War I in the 20s, which were a deflationary time. You rarely see the Fed talk about foreign anything because it's not part of their legal mandate. Their mandate is purely domestic. But I keep wondering, why did they go for 50 basis points? Was it just because Wall Street was pressing them? They couldn't stand it anymore, the press conferences, right? No, I don't think so. Were they worried about the rest of the world? Maybe. The Fed is the global currency. So if you're not cognizant of what's going on in the rest of the world, you're kind of missing something, right? But I think the big issue, really, bottom line is, what is the story now? What are we selling to the markets in terms of the future that is credible? That's what I think the problem facing the Fed is.
And as you point out in the macro picture, that's more of like the rest of the world is in that more, stagnation environment.
I mean, I wrote about the fact that UniCredit, the big Italian bank, wants to take over Commerzbank, second largest bank in Germany. Well, this is a big deal in Europe. They really don't have a fully merged, consolidated banking system in Europe. But the fact that they're even considering this is very interesting because there's no growth in Germany. They're not expecting any GDP growth at all. In fact, there's probably going to be a contraction next year. So the only way banks can manufacture growth is to go out and buy one another. And European banks are no great deal. I could sit down with you in 5 minutes, show you that I don't think either one of these banks has a lot of capital. But that's the only way they can generate the appearance of growth. So we're dealing with appearances instead of substance here, Julia. That's the big issue.
The appearances versus substance. Let's flesh that out a bit more. Do you also think, are we experiencing that here? Is it more of an appearance of a stronger economy? Okay. I would love to explore that.
I just got done editing the new edition of Inflated, which is going to be out next year from Wiley. And I had to add a chapter for the last 15 years, which you can imagine was great fun. And I think the issue, and this goes back to the writings of Jim Grant and others, is that we manufacture the appearance of growth through inflation and through monetary policy. But is that incremental additional dollar of GDP growth that the Fed manages to eke out really a dollar in real terms, or is it just nominal? In other words, are we actually growing this economy, or is it just fluff in terms of inflated dollars? I think it's the latter. I think that's the reason that low-income families in this country are having such a tough time, because consumer price inflation is the big issue this year. That's the only issue that matters, and nobody wants to talk about it. So I think that kind of answers your question, right?
You're right. And so I have, I host this show, and a lot of the guests who come on the show, they are well off. They're very successful folks who come on the show. Probably every single person who comes on the show is. And, I'll get guests who will talk about, it's great. The economy is fantastic. And then I'm kind of scratching my head. I'm thinking, it's not so great for a lot of people out there who are really kind of struggling to put food on the table. They see the prices, and that's where it's hard for me to kind of reconcile that the economy is so great.
Well, historically, the U.S. thought that the only cost of being the global currency was that we ran big trade deficits. And we had to finance them, obviously. That was why we have so much debt. Now we're seeing that not only do we have big trade deficits, but we run higher than really acceptable levels of inflation. And we saw this dramatically during COVID because inflation jumped up. 10, 15% inflation causes political problems. It's just, it's beyond endurance for most people, right? But really, if we're talking about 2% inflation, that's not great either. That takes half of your savings away over 2 decades if you compound it. So for most people, what does this mean? Lower income families are getting crushed. So yes, the top half, if you look at the mortgage market, for example, it's fine. It's no problem. But if you look at the bottom quartile, if you look at the FHA market, for example, where a lot of low income families finance their first home, they are having a really tough time. Defaults are over 10%. So I think that, we have 2 economies here. You and I have talked about this before, and we're seeing that in the politics. Kamala Harris is appealing to the bottom half. Donald Trump is appealing to the top half. Very simple. And, we'll see who wins in November.
So that's interesting. You don't think Trump's appealing to the bottom half then at all?
Oh, no, he does. He appeals to working people.
Okay.
He appeals to the Teamsters. Very interesting that they decided not to endorse a presidential candidate this time. So there is crossover. But what I'm saying to you is that people who are already working hard to make ends meet 3 and 4 years ago, who have seen home prices go up 40%, and who have seen groceries and everything else go up as well, where are they going to go? There's no relief for them. Right. And I think that's why the Democrats are so focused on giving money away, because they know that people are hurting. No, I mean that. I'm not being partisan. I'm just saying the reason such policies don't elicit just complete rejection and amusement is that people are hurting and they need help.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028 when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. I wanted to ask you, so let's say Vice President Harris has a policy proposal, $25,000 for first-time home buyer.
Yeah.
What would you're the person I would want to ask? What would that do to the market?
It's going to raise home prices dramatically. Because, again, going back to Jimmy Grant's point about marginal dollars and making GDP look bigger than it really is, what are you doing when you hand millions of families $25,000 and you have them go into a supply-constrained market, entry-level homes, let's say the bottom quarter, bottom 30% of homes, which are a couple $100,000, but there's no supply. So automatically those buyers, those new entrants into the market are going to become the price setters and prices are going to have to go up. Ed Pinto had a piece in the Wall Street Journal a couple of weeks ago. He's a very knowledgeable housing expert. And he figures home prices would go up 3-5% easy simply because of Kamala Harris. And that would be a transfer from people buying those homes to the people selling. So we're actually going to spend $100 billion. It's going to generate more than that. In other words, it's going to be a net cost to the taxpayer. And we're going to transfer $150 billion to the people who sell their homes.
And those are the asset holders who probably benefited from all of this. Yes.
See, the Democrats don't understand supply. They're really good at demand side Keynesian or neo-Keynesian stimulus going back to the Great Depression, right? But they don't know how to create supply. And that's what we need in this country. We need to build entry-level homes that people can buy for a couple $100,000. I'm actually sitting in one. We have a 70s buy level that's 2,400 square feet, 4 bedrooms, 3 baths, perfect starter house for a young family. But we don't build these anymore. This house was built in the 70s when we were worried about energy prices.
But even the prices
you're
of
probably
those.
too young to remember the energy crisis.
I was born in '88. So I wasn't around then. But I've heard, my parents talk about like the gas lines and yeah.
I didn't know if I had enough gasoline to drive to college. Let's put it that way. I went to Villanova and my parents lived in Washington. It was very interesting. You could only buy gas on certain days of the week.
And based on your license plate as well, or something like that. That's right. My mom grew up in College Park, Maryland, so probably not too far from you.
Everyone had little cars. I remember my fourth Mustang, when I picked it up, it was an 85. It had a boat engine in it because Ford had stopped making V8 engines for most of their cars. That's how serious the energy crisis was in the 70s. And the car ran like a bat out of hell, by the way. But it was a boat engine. It said Ford Marine on it. I thought that was kind of cute.
Yeah. I don't know if this is an area of focus, but it seems like there's been a lot of conversation lately about, the oil market, energy. Do you have a point of view there? Is that something you follow, pay attention to for the macro?
I follow OPEC, and it's interesting. The Saudis have given up on trying to limit supply and force prices up. So now they're just going to produce to the full quota. There are a number of other OPEC members, like Venezuela, for example, that can't even produce half of their quota. So the market has been, I wouldn't say tight, but it certainly hasn't seen prices go up. In fact, when the economy was kind of indicating that we were going into a soft period, prices fell. So it's interesting that the Saudis have given up trying to manage prices and manipulate the market. And now they're just going to produce, because I think they realize that long-term demand for energy is essentially going to go away from transportation, and it's going to go back to where it should be, which is chemicals and other uses for hydrocarbons that are, I think, much more valuable to society. Much as I hate to say, we're going to go to electric vehicles. It'll take a while to get them to the point where consumers are confident enough to buy them. I think Toyota, by the way, has got this right. They're making hybrids. They know that EVs are not quite ready yet, and we don't have the infrastructure or the tech to make them work. But still, they know that over time we got to limit consumption of hydrocarbons, and I think they are putting the right combination of hybrids and existing internal combustion engines out there.
All right. I wrote this down because I saw a tweet this morning from you, and maybe we can go back to more of the housing conversation. U.S. 10-year yields rise above 4% for the first time since August 8th. So what was that about lower mortgage rates? Talk to me about that.
Well, the market ran really for the last 6 months, 9 months. If you go back and look at yields, we had a chart in the blog this morning that showed the 10-year note, which is where we price mortgages, versus the 30-year conventional mortgage. And the spreads have widened between the two. And at the same time, rates have gone up. Why? Because you already had your rate cut before the Fed acted in September. The markets had already gotten there. And I think 6 may be the low point for a little while. We could see mortgage rates retrace back up to 6.5 easily. This won't make people happy, but the structural changes that the Fed caused when they dropped interest rates during COVID, and we refinanced 2/3 of the mortgages in the United States, is going to make it difficult to get people to either sell their homes or refinance their mortgages going forward, because the average coupon today in the U.S. is somewhere a little over 3%. I have a 3. So, it subsidizes me living in New York. Think about it that way. If I had a 7 or a 6.5, it's twice as much cost, right? So I think the problem is the mortgage markets were dying for more volume. They were dying to make more loans, and they still are, by the way. But, 6 is not going to pull many people into the marketplace. You would have to get mortgage rates down to a 5 before you really started to see significant refinance activity. Today, refinances are less than 10% of the volumes.
Yeah.
During COVID, they were more than half. Well, think about that.
Yeah. What would get us down to that 5? Like, what's the pathway there?
Well, you'd drop interest rates 200 basis points. I don't think you have a real pretext for that yet. But, remember, your mortgage coupon, what you pay every month, when they sell that loan into a security, it's about a point less. So if you have a 6% conventional right now, that's going to go into a Fannie Mae 5% mortgage-backed security. And the difference is the spread and the servicing costs and everything else. You got to get interest rates down so that those mortgage securities are trading in the 5s or even the 4s. Okay? That's a long way away, Julia. Long way away. Because people are delivering mortgages today in the 5s, 5.5s in the forward market for new issued securities. So if I do a 6 or a 6.25 mortgage, Fannie Mae, that's probably going to get sold into a 5.5 at a premium. So, but at least the lenders are making money. Last quarter was the first time that mortgage lenders in this country made money in 2 years. So that was good news. But the volumes are going to be constrained. I think that's the headline here when it comes to housing.
Yeah. You are someone who is closely followed when it comes to banks. We are going to be heading into the big bank earnings season coming up. I think JP Morgan is on Friday. They kind of kick it off. But I know we don't have you in the middle of earnings season. Sometimes we do. But what are you looking for?
We know what's going to happen. Don't worry.
Yes.
Q3 is going to be good. The markets were helpful. There was a lot of deal flow, huge issuance in debt and high yield. So Q3 is going to be better than Q2, but I think Q4, because of the Fed action and because of the way the rates have backed up, you may start to see some more compression on net interest margin for banks. Why? Because they're out there looking for assets. They are bidding for assets. And what does that do? That forces the cost for the borrower down. You see a lot of banks getting back into credit. You and I talked about this last month. Remember, banks were trying to get out of stuff that they had bought or low coupon securities, and they were selling this exposure to funds, Ares, people like that, Apollo. They're all very active in this space, right? The private credit trade, we call it. Well, now the private credit trade is disappearing because we have no recession, right? And the banks are jumping back in because they're looking for a return. They're looking for yields. And what's happening is that the yields on average assets for U.S. banks are going to fall in the fourth quarter faster than funding costs. Funding costs are going to kind of stay where they are. So I think you'll see some NIM compression at the end of the year. And you're also going to see house cleaning. People are going to be taking a lot of stuff to the curb that they want to sell.
Yeah. Is there anything in particular that you're looking for from commentary from the bank leaders? Anything that I don't know exactly. We obviously haven't seen a recession, or we've avoided one at this point. No. But anything in particular that you want to hear from the bank leaders?
No, I think they're following the economy like everybody else. The really interesting thing that's going on, Julia, is that Rohit Chopra, the head of the Consumer Financial Protection Bureau, is about to kill the Basel Accord. I think if he does not change his position, and obviously he's very much influenced by Senator Elizabeth Warren, he is saying no to a revised Basel rule. Well, then they may not do it at all. And as I said to my friend Matt Stoller on Twitter this morning, the banks are good with no rule at all. They're good with that, And I don't know what kind of game Elizabeth Warren thinks she's playing, trying to get higher capital put into this proposal, which is not really needed. But she doesn't care. Elizabeth is very much about press releases and shock value. She's not so much interested in substance. But isn't it fascinating that you have this gentleman who sits on the board of the FDIC who may actually kill the Basel proposal entirely? The Fed may be forced to just say, fine, we're not going to revise it. Because if FDIC doesn't come along, they can't do it. All of the agencies have to agree.
And it wouldn't be a bad thing, I suppose.
The banks are delighted. Trust me. The banks could sue and knock Basel out entirely if they wanted to, because of that Supreme Court decision when they got rid of the Chevron doctrine. Every agency finding that is not supported explicitly in the law is subject to attack now. So, the Fed is very much in a defensive posture. The comptroller's office are trying to get a deal. They are working with the banks. But Elizabeth Warren and Mr. Chopra don't care. And since he's the swing vote on the board of the FDIC, if he doesn't change his position, then we just won't have a new Basel rule. We'll have to leave it where it is.
Hmm.
This is called Washington politics, by the way.
Okay. Well, what about, what happens if we see, change in administrations? How might that impact it?
Well, then CFPB will have new leadership and we'll solve the problem. But I think that's, months away. And if the Fed is not able to revise this rule and repropose it, and they need FDIC's assent for that, then they may just kill it and leave it until after the election. But we could see a lot of changes in all of these agencies. You may see 2 or 3 governors leave the Fed. So, we may not see any action on bank regulation at all next year because it'll take time to replace these people.
Mm-hmm. And as a bank analyst, what do you make of it? Good, bad, positive, neutral?
Basel is a very old accord and it needs to be reworked. I've sent in comments and I have talked extensively to people offline about some of the areas of change that need to be made. But unfortunately, Washington is so dysfunctional now, even on fairly technical issues like banking regulation, that getting agreement is hard. We should be more focused on market risk, less focused on capital and credit risk. Because if you look at the numbers, Julia, credit risk is very benign. Other than commercial real estate, there is no sign of recession here. And all of my buddies, Rosie, and the rest of them who've been out on Twitter yelling and screaming about the end of the world, no, there is no recession here. And the banks are topic A. But remember, the banks are typically only dealing with maybe 2/3 of the economy. That bottom third of low-income households are hurting. And It doesn't show up in the bank data. It shows up in the broader credit card data and auto loans and things like that. But if you're looking for a macro broad recession in the United States in 2024 or even 25, I don't think you're going to see it.
Mm-hmm. Rosie's coming on the pod next week, by the way. But I love David Rosenberg. Okay, so we're not going to see the base case, not going to see a recession 2024, 2025, but you did mention market risk. So My question for you is, what are the market risks that you're paying attention to? What are the ones that are keeping you up at night? What are you thinking about?
Well, I did an outline on U.S. Bancorp because I compared them to Commerce Bank in the blog this morning because they're about the same size. But when you look at what you have to subtract from U.S. Bank's capital before you get down to that net figure that the regulators use, it's quite sobering. We still have an interest rate problem for banks. There's still a solvency problem because of all those low coupon securities and low coupon loans that they own on their books. That's going to take time. Banks can't force me to prepay my mortgage. We haven't gotten quite there yet. So these assets are going to sit there. And even though the banks are lightening up, even though they have made a lot of changes that have made this less of an existential problem and more of kind of an earnings problem going forward, I am keeping my eye on that because if interest rates back up, the 10-year is over 4% again this morning. If we go back up to 4.5 or 5, then we have a problem again. And let's remember, at the close of the fiscal year, the Fed had already lost $200 billion. The central bank is insolvent. And they're going to continue to see losses because they pay 5-something on reserves, and now they earn 2% on their Ginnie Maes. So, they have an interest rate mismatch just the way banks had. They've made the same mistake as the banks made years ago. And here we are. It's not a very good picture, but fortunately, nobody in Washington worries about this.
Yeah. Okay. So back to the 10-year with it above 4%, first time since August 8th.
Yeah.
What is that signaling? Can you help us understand? And you mentioned if it goes to 4.5, it could be problematic. Help us understand what we should be paying attention to as it relates to the 10-year.
Well, 10-year is where we price 30-year mortgages, number one. But it also is a surrogate for the mark-to-market on the entire bank balance sheet. I use the 10-year note and also some mortgage securities when I'm doing my estimates for solvency for the industry that we publish. And, essentially, if I've got a 10-year above 4, I'm going to probably do a mark-to-market on the balance sheet assets of the banks of about 15%. That wipes out their capital. So, having those high interest rates or relatively high interest rates is still a problem for the banks. And people don't like to talk about this. They want to focus on earnings, but it makes the bank balance sheet really frozen. It limits their flexibility. And that's why banks that had, like KeyBank, for example, got rid of a whole bunch of low coupon securities after they got an investment by Bank of Nova Scotia. Well, that's great, but they still have more stuff they have to get rid of. So either they're going to wait, and this is Bank America, this is many other banks, and just let those securities sit there, which will hurt earnings, or they can bite the bullet and sell them, but they have to take a loss. So this is the same problem the industry had at the beginning of this year. It's not as bad because of where interest rates are now versus, say, 5% on the 10-year. But that's what you want to watch, because that 10-year note is your surrogate for understanding how much of a pain point this is for banks.
Can I sneak in one more question before I let you go?
Sure.
Okay. So we will have you on, I was just checking our calendar, we'll have you on Monday, November 4th, so the day before the election. But
yeah,
this is our second to last time having you on. We have been talking about the election in recent episodes. Would love to get the latest from you. How much, maybe more from that more the economic markets lens, but how you're thinking about the election. I know you have talked about your base case in recent episodes has been a Trump victory. Has that been reinforced or changed? Just maybe I'll just leave it more open-ended. You can take it where you want to, but how are you thinking about the election?
Well, look, Trump has national name recognition, whether you love him or hate him, right? Kamala Harris, not so much. She is an unknown quantity for many Americans. And I think that they have been trying to address this, but the Democrats have been hamstrung this year, first because Biden didn't want to step aside. And, vice presidents never get any love. You never see vice presidents in the spotlight. They're always in the background. So when suddenly Kamala Harris had to jump in here and become the candidate, that's a difficult slug. But I think Trump is doing well enough in the swing states. I think he'll take Pennsylvania. I think he'll take Arizona and New Mexico. So because of that, I think he's going to win. There are some conservatives. Dick Morris was out on the line yesterday saying he sees a Reagan-esque kind of landslide. I think it'll be closer than that. But, bottom line is that inflation and immigration, those are the two issues in this election, Julia. Those are the issues that people care about. Everything else, it drops down into segments of the electorate. But if you want broad issues, it's going to be home prices, consumer price inflation, things like that. And I think that ultimately they're going to look at the last 4 years and compare them to 4 years of Trump. And as much as, I have a column I just wrote that compares Trump and Kamala Harris. I said housing will be ignored by Trump. But if we have 4 more years of Biden and Harris, I really don't know if the industry is ready for that, because the silliness and the lack of competency in a technocratic sense on issues like housing have been a problem. That's what I do. I deal with Treasury and the major housing agencies in Washington. And God help us, other than Sandra Thompson, who I love dearly and who did some really good things at the regulator for Fannie Mae and Freddie Mac, the rest of the crew was really lacking. I mean, really lacking. They're all gone, by the way. They've all left. So, Harris, God, I don't know. My world is housing and banking. And I think we'd be better off with Trump, to be honest with you.
Chris, I want to give you the final few minutes here. Any parting thoughts? Anything you want to leave the audience with to think about? Plug. I know you have the Stanley Middleman book. You have the reprint of Inflated coming out next year. The floor is all yours.
Well, the Middleman book is doing really well. I am so pleased about that project, because Stan is a real American entrepreneurial story. He started on food stamps as a substitute teacher at Temple at night. And, here he is as the owner of one of the biggest family-owned businesses in the United States. He's got 2 really smart kids who work with him in the business. And I think it's just a wonderful story. I remember when I first interviewed him, we were talking about his early days, and he said, I wish I could come up with a way to have a business so I could go to the ball game. Well, now Stan owns part of the Phillies. He bought out the Roberts family, about half of their stake. Great business, by the way. Great partnership runs that team. And so, that was a happy set. But I'm looking forward to Inflated next year. I think that's going to be a very topical book. When I wrote it in 2010, it was too early. People didn't think inflation was a problem. They think it's a problem now. And we had a lot of fun going through the last 15 years. So I'm looking forward to that. But you can find me online at the Institutional Risk Analyst, on X at RC Whalen, and of course, my column at National Mortgage News.
Chris Whalen, chairman of Whalen Global Advisors, author of The Institutional Risk Analyst. Always a pleasure to have you on the show. We look forward to it every month. And thank you for being our special guest on episode 200. Always great to have you.
I feel so honored. Thank you, Julia.
Thanks, Chris. Day.